November was an eventful month for investors, as the victory of Donald Trump as the US presidential election surprised pollsters and translated into a rally in risk assets against expectations. In the meantime, fixed income markets experienced headwinds as the improved growth outlook and higher inflation expectations led to a rise in bond yields globally. Hedge funds were cautiously positioned ahead of the US election and, as a result, did not fully benefit from the rally in risk assets. On the contrary, the rise in bond yields impacted negatively some strategies, and CTAs in particular underperformed due to their long positions on fixed income and the sizable trend reversals on commodity markets and in particular energy. On the foreign exchange market, CTAs lost as well, to the extent that their long GPY positions against the US dollar and long positions on EM currencies suffered in the wake of the US presidential election. On a positive note, long-short equity and event-driven strategies outperformed, and in particular on the long-short equity side, the managers with a value bias exposed to companies with lower valuations outperformed significantly in November. On the event-driven side, managers benefited from the deal spread compression across several mergers, such as the LinkedIn Microsoft or the Monsanto Bayer. Deal spreads across the board hedged lower during the month of November, benefiting event-driven strategies. With regards to our investment recommendations, they have evolved to take into account the new market regime that has started to take shape after the US presidential election. We have downgraded short-term CTAs to neutral. The environment for trend followers is less supportive going forward, while we have upgraded strategies with higher market directionality, such as long-short equity, long bias, or special situations. With regards to special situations in particular, we find the environment more supportive for the strategy going forward, to the extent that tax cuts, financial deregulation, or infrastructure spending might impact companies differently and create differentiation across sectors and across companies within sectors. As a result, the opportunity set for special situation has improved, and both long-short equity and special situation strategies have recently added to cyclical sectors such as industrials, materials, or financials that are also benefiting from the steepening of the yield curve.